Hello, everyone, and welcome to Five Star Chemicals monthly presentation. I'm Erin Hamrick, the marketing manager, and just a couple of housekeeping things before we begin. If you want to say hello in the chat over to the right, please do so. I know that Michael has a couple questions too. If you want to answer them, you can do so in the chat. If you do have questions for the Q&A at the end of the presentation, please use the bottom prompt that says ask a question so that everybody else can see your questions and we can make sure that we get to it at the end of the presentation. Our next presentation next month is with John Palmer and a review of hop bittering, and that is September 22nd. So we hope to see you there as well. And with that, I will hand it over to Michael Shepard with On Tap Credit Union.
Thank you very much. Thank you for allowing me to come back on again. And I think we're actually going to join one more time in October. Thank you everyone for joining us. A quick background on me and my experience is my banking experiences. I've worked in the financial world for about 15 years now. I started with a large retail bank, just started off as a banker, got out of the brewery business. I was working for a brewery and restaurant here in the Colorado market. Then I went to become a business banker for that retail bank for a little over 3 years. And then as a branch manager for several years with that retail bank. Introduced to the credit union world. Someone I worked with in the retail bank was like, hey, you need to try the credit union world, which I will tell you is a much better world than retail banking. And so about 10 years ago, I started in the credit union world. And then I have worked for On Tap for just over 4 years, which is really exciting because I get to balance a little bit of my business experience and the brewery experience. And they hired me to focus on the craft brewery world and to help them find ways to craft solutions for the breweries to achieve their financial goals. I'm extremely passionate about the business side. However, just know On Tap can also help you and your team with your personal financial goals. Also, we collaborate with a merchant service provider. We have a financial investment advisor, a payroll service provider, and even an insurance broker that can help you. So On Tap is actually your one-stop shop for any of your lending needs, whether it's on the business side or even on the consumer side. So who is On Tap Credit Union? On Tap Credit Union started as Coors Credit Union in 1954 by a few employees of Coors. Because employees had to pay for their uniform, the credit union's first loans were Coors employees to purchase their uniforms. This is how we became beer people helping beer people, and we've continued this legacy. The credit union continued to grow over the last 68 years, and we now have over 20,000 members and over $300 million in assets. So we may be a smaller credit union, but we definitely have the assets to lend. We have also been member owned, and our membership extends all over Colorado and the United States. About 6 years ago, we decided to make a name change, but we wanted to keep our beer heritage. And that's how we felt the On Tap name kept our beer roots. And then now here we are, almost 70 years later, beer people helping beer people. And we've got quite a few of partners that we partner with. So some are brewery partners, over 40 brewery partners. And we put some of their logos up. And On Tap has helped them using a consumer loan or even a business loan to open, grow, or put their brewery in a better financial position. Some of the examples we have and the logos we have up there are Lady Justice, Holidaily, Mad Jacks, Welcome Home, Long Table, Tommy Knockers, Flight Co. And we're actually helping them with both of the locations. They just opened up a Flight Co tower in the Stapleton area. It's amazing. Landlock Ales, Mountain Toad, Rails End, Banded Oak, Live Slow, Joyride, Over Yonder, Six Capital Brewing, Guanella Pass Brewing, actually both of their locations up in the mountains here in Colorado, Myth Maker, and Highside, just to name some of the different brewery partners that we've associated with. We've helped them one way or another. So today we just want to talk about, you've already started. So what's the best way to not grow yourself broke in the brewery world? And I think it's really important because we run into these situations as we cover the 3 biggest mistakes that brewery owners make constantly. So U.S. Bureau of Labor Statistics state that more than 20% of small businesses in the U.S. end up failing within the first year. And of those, 50% fail by the 5th year. Craft breweries, we talked about in the last presentation, is that that segment is actually right in line with those percentages of how businesses fail. Another surprising statistic I think you'll find is, and why we're going to talk about not growing yourself broke, is 2/3 of businesses that file Chapter 11 bankruptcy, they're actually profitable. So brewery owners need to understand their financials. For example, I had a friend, and it's not in the brewery world, but from college, who actually started an advertising agency, and he was making millions in gross revenue. Within 5 years, the business was bankrupt and had over $2 million in debt and owed back taxes. He only paid attention to the top number, and we have an example of this a little bit later. And in borrowing, he was assuming he was cash flowing. So that's the point. Just because you're making net income doesn't mean that you're cash flowing. And we'll have an example of that just a little bit later today. So why do they fail even though that they are profitable? So the big reasons that businesses fail, first one, lack of understanding of cash flow mechanics, excuse me, and lack of understanding of financial statements and misusing of borrowing tools. And we're going to cover all three of these typical mistakes that brewery owners can make, or even small business owners make. So because you're making good beer does not mean you'll be profitable, especially now. The concept of brew it and they will come does not exist. There's more competition in the craft brewery world, plus even more choices and varieties of craft beverages. So now, not only are you dealing with other breweries that may be opening up close to you, distilleries are opening up, speakeasies, and wineries are opening up. So that's increasing your competition for reasons for people to go out, but there's more selection for them. So you want to make sure that you're running a profitable business. So let's jump into mistake number one. So, and I see this so many times when trying to help a brewery with their lending needs. That is the number one mistake small business owners make, is they manage their decision. They make a management decision based on their financial decision to manage their tax liability. Their income statements are always slightly negative or significantly reduced. And I see this constantly on somebody's tax returns, or I see it on their P&L, income statement, and balance sheet. They are doing their best so that they don't have to pay taxes. And we as a financial institution have to show the ability to repay when we're underwriting those loans. So I fully understand nobody wants to pay taxes, but breweries make a decision to show the little or no profit. So they show a loss to avoid paying or greatly reduce that tax liability. However, we need to find a way to find a balance within those so that you're making money and reduce that tax debt or tax liability. So for example, someone makes $1 in profit. For every $1 in profit they make, they pay 40 cents in taxes. So they end up net 60 cents in profit. So they don't want to pay taxes. So they're going to spend that dollar instead of showing the profit and just paying the taxes. They might buy equipment or a new car, something they may not really need. But when you make that decision, instead of reinvesting the profit back into the business, the owner decides that spend the dollar profit. Some decisions are using that profit by buying, for example, a larger brew house, right? Because they assume, hey, if I make more beer, I'll sell more beer and I'll make more money. Of course, that's not always true. It needs to be a sound financial decision if you're going to increase your brewery production. Some purchases are frivolous, right? So they decide, and I see this, they decide to pay for their personal vehicle using their business expenses. And so they think it's a write-off. So they're going to benefit in the end, in which it can hurt them. So we need to, or they make a decision, hey, let's expand into the next adjacent unit for more seating. Because again, if I can have more seats in there, I'm going to make more money. So some of these can be actually really good decisions if the business truly can support the increases. And again, you just want to make sure that you're financially making a sound decision if you want to grow and expand your business. So would you rather make $1 in profit or spend $1 to save 40 cents in taxes? You always have to manage your business to a long-term picture. And I stress that all the time, even before a brewery opens up. If you want to borrow money or have that ability to grow and expand, you don't want to just manage this year's tax liabilities. So businesses that can show consistent profits and strong retained earnings are worth multiple more times than those who manage their tax liability. So those spending ideas can be great, but you have to find a balance with your accountant, especially if you plan to borrow money or even if you're in existence that you're going to grow to a point where you sell that business, you want to show on paper that you are making money. People talk about how you can back different things out. However, that's not always, when someone gets some forensic accounting and they dig into your taxes and they want to see where you're writing off stuff, they're actually going to find out that maybe your business isn't as profitable as you think you are. And again, we're going to show that kind of on the cash flow side, which kind of leads into what we talk about is the second mistake that brewery owners make. It's awesome to see on the side. You can see everybody saying anywhere from Mexico, New York, California, Indiana, of course, Colorado. Brazil. I think I remember Brazil from last time, Massachusetts and Hawaii. Appreciate everybody joining today. So let's move on to mistake number 2. And that's what we're talking about, where it's going to talk about in the cash flow. So the number 2 mistake small business owners make is they focus on the income statement and never heard or looked at the statement of cash flow. And that's where we lead to this next subject, and mistake number 2, it's the cash flow. So as we talked about in the beginning of the presentation, 2/3 of businesses that file Chapter 11 bankruptcy are profitable. So these are the businesses that are filing to try to restructure their debt so they don't have to close their doors. Oftentimes they file this BK on their most profitable year. And it is amazing to me. When you start dealing in business and you talk to business owners or why they closed the business or why they failed in the beginning, you run into this more often than not. So they failed because they did not manage their cash flow and could not pay their bills when it came due. Ooh, and we're seeing, that's kind of neat, seeing somebody from Ukraine chiming in. So growth is good, right? And that could be a good and a bad thing. So you remember at the beginning of the presentation, I mentioned I had a friend from college who started that advertising agency, making millions of dollars in gross revenue. Within 5 years, he was in that category of, he was bankrupt, owed $2 million to the banks, and also owed back taxes. He only paid attention to the top number, assuming he was cash flowing. So when you look at this, this is the first page we're going to talk about, is that we've titled this Joe's Brewery Income Statement. And this is where a lot of people, a lot of business owners look at and think, okay, I'm doing great. And this is where the question is, growth is good, right? So year over year, you see in Joe's Brewery at the very top of the income statement has been increasing every year. So from the first year, year 1 to year 3, their sales grew from almost 2.3 million to a little over 4.5 million. This brewery is just rocking it out. But look at the bottom number, their net income was also growing. So if you go to the very bottom of this income statement, you see the line net income. You notice their net income grew from year 2 to 3, but at a smaller percentage than from years 1 to 2. Now, some of this can make sense. It costs you more in cost of goods sold and expenses to produce more. So you're going to spend a lot more in the expenses, but you're hoping that your rate of return is still the percentage that you decided that was a really good number. So when we're looking at this, we ask the question, seems like growth is good, right? Well, let's take a look at their cash flow. So the sales growth can be good, but it depends on how it's financed. So in this statement of cash flow, and your accountant can help you with all those, help you with all this process too. So if you have a good accountant, they can produce all your P&L, income statement, balance sheet, and the statement of cash flow. They can show you, are you really truly a cash flowing business? So depending on how it grows and how it's financed side is, you have allowed more people to owe you money. So if you look on this, if we start going down, right, you see their net income, you get to write off some depreciation, but accounts receivable, right? So that number grew. So because you've allowed more people to owe you money in accounts receivable, that number went up. Because you have to spend more money in inventory, and inventory holds cash. So until you sell that inventory and makes you money, i.e. cash, it's costing you to have inventory. So again, you see that's where it's important to turn that inventory. If you also move down a little bit, you're going to see accounts payable. Well, because you have increased that inventory to make, serve, and package your beer, you now owe more people money, right? Because you want them to invoice you at 30 days. Now, if you look in the about maybe a third of the way down, that operating cash flow in bold, it's negative. It's actually, you're running a negative cash flow. Next category that's important to talk about as we get to the bottom of that cash flow is, you also see in bold letters it says cash flow before financing. So Joe's Brewery is operating with a negative cash flow. So what are they going to have to do? They're going to need financing to stay open. And that's where you see in the category short-term and long-term banking debt. We talked about in the last presentation that there's short-term, mid-term, and long-term. On this cash flow sheet, you can add the line of mid-term, but they've all grouped it into the short-term banking. So if you can see in year 2, that short-term debt include either a credit card or lines of credits. Joe's Brewery is using short-term debt to stay in business. Look at that. They needed $143,000 in year 2, and then $348,000 to try to help offset that cash flow. So what's happening now, Joe's Brewery is using short-term debt to stay in business. And that year 3, they're in a negative cash flow. So just because you're growing does not mean you're cash flowing. All businesses needs cash, and we talked about last time, the majority reason those businesses fail or run out of money is that they've decided to use short-term financing to stay alive. And this is possible to stay afloat with short-term financing, but eventually it's going to catch up to you. So when you look at this business is insolvent. However, it will not fail until that financing runs dry, and that's what we're talking about. So maybe somebody made some back of the napkin calculation and said, hey, you know what? We have a 7-barrel system or a 5-barrel, 3-barrel system. We need to jump up to a 10-barrel system, because if we do that again, I'm going to make more beer. So we're going to make more money. We're going to sell more beer and make more money. Or they made a decision, let's make more beer so they can get into the production and distribution. And we see that all the time. And in production for distribution, your margin drops considerably. So what you make with a draft beer over the top of a bar top, as opposed to putting it in a can and selling it, that can is you're going to get a smaller proportion of it. So, does it really make sense? So, what happens if you don't see those sales materialize? What were the costs to consider? And that's that one we talk about in distribution. Did you really take in all the costs, consider it? Self-distribution, to let somebody else do it. So can never grow out of an improperly structured balance sheet. Improperly financed growth simply compounds the problem. And that's the example that we were showing you with Joe's Brewery, is that he's actually kind of financed himself into a bad spot. He's going to keep the doors open for a little while longer, but eventually it's going to catch up to him unless he can figure out how he can put more cash flow or increase his sales. So understanding where your cash is coming from and when that cash will be coming is so very important. So that's that cash flow piece of it. If it's coming from financing, your survival is dependent on the decisions your banker make. So you come to us, do you have a cash budget? Is your business generating positive cash flow after operations on the cash flow statement? And that is something that we pay attention to and we think is very important, because ultimately we need to make sure that we put you in a great financial position, that your business can grow and the sales make sense. And again, if things go bad, are you currently making enough money to cover that growth opportunity if you decide to use that cash? Here's mistake number 3. They borrow incorrectly. So it is so important that you understand the different types of lending tools that are available to you out there in the market. Okay. The three main types of loans are short-term, medium, and long-term lending. So in your short-term lending, that's when you talk about credit cards. That's when we talk about lines of credit. Use these short terms for operating capital, cash flows, management, security blankets, and short-term needs. Term loans are those medium. Term loans are for your equipment, improvements to any of your assets or your collateral, business assets, or your medium term, and then your long term are your real estate. If you go to purchase a building, and if you want to break down of these type of loans, just for time reason, is if you go back, we just did a 5-Star Chemical podcast we did back on June 30th. We did a larger breakdown, and we broke down each one of these types of loans: short term, midterm, and long term. And then we gave you the pros and the cons of each and how each one of these should be used. So the loan that gets the most people, when we talk about, borrowing money incorrectly, the loan that gets the most borrowers into trouble is what we call a line of credit. So they use a line of credit to buy equipment because it's interest only and a cheaper payment. They use a line of credit to fund consistent negative cash flow, never paying it down. I'm going to reference back. That's an example we had in Joe's Brewery. Is they've made a decision and they're using that short-term cash flow to be their Band-Aid to keep their business functioning. They use a line of credit to fund operations without paying it down when it comes in. It's so very important that short term is that you pay it down. I referenced that we broke down each one of those loans: short term, midterm, and long term. We broke it in the previous podcast back on June 30th. And I will tell you, a line of credit, a short-term lending solution, every brewery or small business should have a short-term financing tool for their working capital needs, like a line of credit or credit card, if used properly. Again, if used to fund consistent negative cash flow, you're not using it right. If you buy that piece of equipment and you decided, hey, I'm going to buy that equipment using that line of credit because my payment is going to be so low, unless you understand how to make a larger payment to pay that down, you're going to wind up paying a long time on a line of credit, and you're never going to wind up owning that piece of equipment, which can definitely subtract from your cash flow, your ability to pay those things off, and then it's a debt you're going to carry on for a longer period of time. So here's, we're going to ask a question that everybody can give their answer in the chat. If you borrow, or if you buy $50,000 worth of hops from a supplier who offers you the terms 210 net 30 for the invoice, and let's talk about this and make sure everybody understands what 210 net 30 means on an invoice. So what this supplier has said is, you owe us $50,000. If you pay it in 10 days, we're going to give you a 2% discount, so $1,000 savings on that invoice. Or in 30 days, you're going to owe us. So here's what I'd like everybody to do to answer in the chat. Should you borrow off your revolving line of credit at a 7% interest rate to pay the invoice in 10 days? I have an answer with an exclamation point. That's good. So this is asking you, what's the best idea to use that short-term loan? What's the best idea? We have a nothing. Quite a few no's coming in. Oh, and a no way. So the answer is yes all day long. It significantly improves your cash flow. But here's why. It's someone asking you ready to turn around and pay off. You can pay off that revolving line of credit, but here's why. So if you get the discount and you pay it in 10 days and you use your line of credit, the short-term lending, you can get the discount. So you've just saved yourself $1,000, right? And you can draw off your line of credit, so you advance it. So you don't have to pay $50,000 of your own cash. You can keep what's in your bank account available for you to use, draw on the line of credit, and then that $1,000 you save, right? You can use those funds for payroll or whatever reasons you have during that month. So my suggestion is you can still pay that line of credit. So after 30 days, you'll get a statement cycle, and in 15 days, you owe typically within 15 to 20 days. From that point, you're going to owe that payment. And if you pay off that amount you use, it'll only cost you just under $300 to do it. So you're still netting $700. Plus, you're not using your cash that you have in your account. As you know, you might need that money. So that's the smart way to use short-term financing. To the example of the line of credit, the way it's used incorrectly is if you use that loan incorrectly and you carry that $50,000 balance for over a year, you're going to pay significantly more in interest than you would if you just wouldn't have paid the discount. So that's the smart way to use this. This is how you can take advantage of short-term lending. Lines of credit, you can pay those off and use them all day long. Interest only accrues when you draw out there. So we as a financial institution make the suggestion, use that line of credit. Don't use your wallet to pay those bills. Thank you for everybody who was asking. And definitely you can repay that line of credit quickly. Lines of credit, so you know, typically are, you have like a 5-year draw period. So no different. This is why a credit card is similar. As you use it, you pay it off, you have that availability to use that amount. Again, you only pay interest on the amount that you're drawing on. So take advantage of discounts. Line of credits, take advantage of the discount. Bridging the cash flow cycle. We talk about all the time, whether you're paying an invoice or let's say you have payroll needs, and then maybe you are in distribution, but you won't receive the payment from the distribution of the proceeds until maybe 45 days after that point. You can keep bridging that gap. That's what it's there for. Remember, bridge the gap. Don't use it as a loan. Don't treat it like a term loan. So it's your security blanket, peace of mind, knowing you have the ability to cover unexpected expenses. That a child being born is definitely an unexpected expense for you. Let's talk real quick about term loans. We talked about those medium loans. Medium-term loans is, as we discussed before, is you can always have the opportunity where you can use your line of credit. Let's say you just want to go buy a piece of equipment. Why we want to make sure that we show that you're cash flowing is we have the ability to turn that piece of equipment into a term loan, pay off your line of credit, which is better for you. The loan is structured with a down payment amortization designed to ensure that the assets are paid off prior before its end useful life, which is so important because we do look at the way you depreciate equipment. All financial institutions you do. So there's nothing worse for an income statement than having an asset that you're still paying for. Again, use the line of credit wrong, but if you use a term loan, we say, hey, in 5 years, you're going to own this piece of equipment. Your depreciation schedule is maybe 7 to 10 years. You're still ahead of the game and you still get to write off that depreciation past the point where you paid off that vehicle. So again, if you show on your financials that you're cash flowing, you can afford the principal and interest payment. If you cannot afford that principal and interest payment, then purchasing equipment maybe doesn't make sense. So you've made this decision as a brewery is, listen, we're going to jump to a 10-barrel system or we're going to jump into distribution. Does it really make sense that you're going to do it? Can you afford the equipment? Should you contract brew? So, and these are the type of conversations we have, and that's that benefit of knowing the industry. So when we talk about knowing the industry and we talk about helping you along to avoid those 3 mistakes the typical mistakes that brewery owners make is you should have 3 trusted advisors. And I stressed this in the previous presentation, and I promise you I'll probably bring up in every presentation is you should have an accountant, an attorney, and a banker. The important thing is all 3 of these people will want to help you in different ways. However, the balance we can help you out is each one's going to make a decision for you that's going to benefit you. An attorney is going to protect you legally. The accountant is going to make sure that you take advantage of any and all those tax breaks or depreciations so you can reduce the amount of liability or money you owe in taxes. And a banker is going to help talk you through the process of, hey, let's communicate with the accountant. Let's see how we can set up and make this more profitable so you can borrow money. So the question is not what the cost is of having that accountant, the banker, and the attorney, but what value are they bringing to my business? Everybody should add value to your business. If they're not, maybe they're not the right person, the right fit for you. So the great ones, the greatest of all time, will have the following characteristics. And I said this before. Knowledge of your industry is so very important, right? And all of us, all 3 of us, accountant, banker, and attorney, have to have a strong desire to help you be successful. It should be somebody that is easily in contact with. I will tell you, all my brewery partners can reach out to me via text or email and anytime to be able to get a hold of me. Willingness to disagree with you, even when it's not what you want to hear. And I come across this conversation more often than not, is that instructing them how to set up their finances on how could they show that they're making a profit, and to go have that conversation with the accountant of what maybe makes more sense. So in finding that financial institution, almost 100% of businesses approach this process 100% of it backwards. So when you're in that lending need, the primary goal of somebody is like, listen, I just want somebody to give me money at the lowest rate. Unfortunately, banking is no different than any industry. You get what you pay for. Do your due diligence. Just because they're lending you money at a low interest rate, are they going to be somebody that just gives you the money and they don't see you again? So oftentimes, business owners will treat every loan decision as a transaction. They farm out to as many financial institutions as they can, and they're like, hey, here's our lowest bid, or somebody's just willing to say yes. So they save a few dollars every month on their payment, but what is the cost? And I'm saying the flip side is what I was talking about is someone said yes to them. There might be a reason that most financial institutions may have told you no, and that hopefully they're giving you that feedback of why it's maybe not the best decision, because you may be in a bad cash flowing position or spot. So if things go bad, a few dollars they saved every month then can cost them millions in the end. And it happens. It's unfortunate, but again, it's why you want those 3 trusted advisors to give you good sound advice, and be able to have that conversation with you, and an open, honest conversation with you. So interviewing bankers should start long before you need the money. I come across this quite often when people are like, well, I don't, when I go out and introduce myself is, I don't need money right now. And actually, when you don't need money is probably the best time or best financial spot you can be in to set yourself up. So we can set you up for success if whether you're using that short term, medium term, or long term, even especially long term, if you decide, hey, I want to borrow, I want to go buy the building, or I want to buy the building my brewery's in. So you want to ask the bankers and even those other 2, the accountant and the attorney, do they have the experience and knowledge of your industry? That is key. I come across this even more so for accountants, and I will tell you is reach out to your Brewers Guild in each state that you're in, or country for that matter, if you have one, and find out, do they have a list of preferred accountants, or reach out to other breweries around and ask them who do they use, because that accounting piece is so important. Do they have the products and services you require? How are the credit decisions made? The further you are from the local source, the worse it's going to be. So if you're reaching out and you go nationwide and you just find a bank in another state that you don't live in, and they just want to lend you money and give it to you, just remember, you might not have that convenience, or you won't have that convenience of that local face-to-face kind of contact. So example is if you're running into problem loans, how is it handled? Are you having to call somebody? Do you have to call a different department, or do you have that contact with the banker? Hey, I can just pick up that phone and call them and answer the questions. And then how often do they want to see your financials? This is key. It's key for us and it's key for you. So us as a financial institution, we require financials on an annual basis. So for example, after the 2022 year, in January of 2023, we'll reach out to the breweries that we have loans with, and we'll request their year-to-date financials for 2021. So we want their P&L, we want their balance sheet, we want their income statement, and we also want a personal financial statement. The benefit is we want to see how the business is running. The downside is it's 12 months for us to have a snapshot. So if there's no communication in between, we may not know there's an issue happening or something we see that might not be good. And then sometimes we see something that's positive. We can help you maybe pay off a loan quicker or put you in a better financial spot. On the flip side, why we stressed in the beginning, it's so important that you understand your financials, is you will see your financials on a monthly basis, hopefully from your bookkeeper or accountant. So you can look at that P&L, income statement, balance sheet, and cash flow. Are you really cash flowing? Is everything running like you think it should be running? And that gives you that opportunity that maybe you can ask the question before we look at your finances about 12 months later, or speaking at the beginning of the year on an annual basis. So always remember, no, we can't lend you money, and here's why, can be far more valuable than here's the money, knock yourself out. Again, you want those people who are on your side giving you sound financial advice to help you out. So it's not just here's some money, go on your way, here's the interest, and we hope you pay us back. So let's kind of talk about loan workouts and avoiding failures. That's the next piece of this. It's kind of probably more about mistake number 4 that people can make, is just not communicating and not realizing what's happening in your finances. So what happens when your business starts to become one of the 50% that fail? So 80% of actual failures are self-inflicted. The business could have been saved, but the opportunity was lost due to ego, fear, or lack of knowledge, or a little bit of all three. So when we go back to talking about, make sure that you're reviewing your financials, all those financial statements on a monthly basis, and some people review them on a daily, if not weekly basis, but make sure you have a pulse on it. So when things start to go south is when the choice of an accountant, attorney, or banker can save you millions. This is where you have the opportunity to reach out, and for my brewery partners, just reach out to Michael. Hey, we're noticing our sales are kind of dipping. In the current market today, you really have to deal with a lot between inflation and supply issues. Is you want that opportunity to reach out. I think people fear that if you tell us that things may have kind of dipped over a couple months, or maybe you're trending over a 3-month period, that the financial institution is going to come back and say, all right, we're just going to call the no due. That's not the way that works. So just remember, the time to contact your banker is when you start having concerns. Assume you made a correct banking choice, meaning you've partnered with somebody who understands your financial needs. So if you wait until you're not sure, how will you meet next week's payroll? There's not much that can be done. And I will tell you, again, in my experience and many years' experience in the financial world, is people finally reach out to me because they're in dire straits. They've maxed out that short-term credit line, so whether it's a credit card or line of credit, and now they're trying to figure out, how am I going to pay the employees, because I'm waiting for somebody to pay my accounts receivable. So make sure, again, you want to be set up in the position. Why I go back to where that line of credit is probably one of the best things you can set up for your needs if used correctly. And I'll state that every single time. So any chances of working out a problem requires you to be proactive and not reactive. Work on that relationship. Have a good relationship with a banker. Why we stress that, hey, that we want you to be local, because again, you have contact. Now, that being said, the other piece of it is, if you don't go local, make sure you partner with a financial institution such as OnTap that understands the brewery needs. So if no opportunity exists, then business will be liquidated, which is the worst case scenario, because financial institutions' goal is to get you to repay the loan back. We don't want to own the brewery equipment. We don't want to own the building. We don't want to own the business vehicles associated with it. We lend you money to be successful. That's what we want you to do. That should be the goal of any financial institution. So again, it's why we make the smart choices of, maybe it's a good idea, maybe it's not a good idea to lend at this time. Let's put you in that financial spot. So a banker can be your best friend. The good news is the choice is yours. The more you can do to help them achieve that goal, the better it is for you and the brewery. So I can't stress that enough. That is the communication piece of it. So taking a confrontational approach to only ensures the process will drag out. So just make sure it's okay if you're having issues that you reach out to the financial institution, right? So check your ego at the door, and that's a two-way street between your banker, you, and even your accountant and attorney. So the good news, let's talk about the liquidation scenario, is that it can be avoidable. That's where you're building that team of trusted advisors. Again, why I stress, find that banker, attorney, and accountant that's going to fit your needs and understand your business. Communicate with them early and often. I will tell you, in the 4 years I've been with OnTap Credit Union, there are some relationships I built in the beginning, and we're just now getting to the point to where we can lend money to them. They were a brewery that was going to open up, and they followed what we talked about, making sure you show a profit, or they put their ducks in a row and they're going to be opening soon and ready to grow. I've had also where we've had 2 great opportunities for breweries who are actually expanding to their second location. And we talked about how we built that relationship with them. We were able to lend with them for their first location. We built up that business history with them. And when I go to my loan committee, that's even better, because we've shown a history of the ability to repay, and they do repay. So that trusted advisor and communication with them, you use them as that sounding board, bouncing off ideas with them, and it's constant for me. Take advice to heart. A loan denial does not mean you go find someone who will say yes as quick as possible. It's you take time, you understand why they are saying no to you, or why they might say, you know what, you wanted it for this term. Here's our rate. Here's our term. Here's why we can show you the payment, and then reconsider your plans. We also get presentations that they are projecting future income. And unfortunately, we can't use future income as the ability to lend. We have to use what your current income is. The exception to that can be is if you're showing good cash flow and maybe it's a little riskier, and we're able to craft that solution, we've been able to see that you've been able to grow and take your plans and move forward with them. So there's a little piece that we can use for that. So keep abreast of your industry, your market, your economy. What will differentiate you, and we talked about it before, is nowadays competition isn't just your craft brewery that's down the street, around the corner from you. You have distilleries and meaderies, and everybody's coming up with a craft drink or craft solution. And especially now, I would say that even more to the point is everyone has seen the supply chain issues. So we had breweries that were back in 2020 decided to go into distribution, which helped them greatly. Well, then what we ran into, as you see, is aluminum started becoming short, and then you couldn't get the cans, or the cans went up in price. It's knowing what's happening. You want to be proactive in the approach. And I'll use another example is we helped a brewery. Ball had made the statement that your minimum order had to be basically a semi. I think it was $150,000. And we had already set up somebody with a significant line of credit, a brewery. And so they were able to just write a check. So those was proactive. We set up that line of credit. They didn't draw on that line of credit for 2 years, and then they needed it. So then they were able to use that line of credit to benefit them. So building a successful and valuable small business is hard. We fully understand that, and we really are here to help you. Just make sure you're working smarter and not harder. Smarter is sometimes allow other resources to be able to help you grow. Lean on those trusted advisors and make sure they're adding value to your business. And that's that point of local is nice, or you want to make sure, hey, I can reach out to them and they're going to answer their phone, one, or two, they're going to get back with me within a day. Sometimes it might be a 24-hour period, but make sure that they're not avoiding you. It's a two-way street. It's the same as when I reach out to my brewery owners. They're really good about getting back to me. I feel that I owe them that same courtesy. So anyone can do your taxes, create your operating agreement, give you a loan, but find those ones that are willing to share their success strategies and will guide you around the pitfalls. And there's where OnTap has that benefit is over the last 4 years, we've grown our portfolio quite well in helping breweries. And we understand the pitfalls. We understand the strategy you need to help grow. Most importantly, leave your ego at the door. Be willing to learn from those who have more experience and knowledge than you. There's a lot of them out there, and it's not just those 3 people I talked about. Reaching out to other brewery owners, talk to them about where their success has been, where have their hurdles been, what can they do, what did they do and learn that can maybe help you from running into some of those pitfalls that other breweries have ran into. So in summary, don't grow yourself broke. Do not manage to your tax liability. Manage to where if you want to grow, you're going to have to show a profit. Understand your financial statements and cash flow. I cannot stress that enough. You should know the insides and outs of that. And if you don't understand, your accountants can help you with that portion of it too. And then how to borrow. Use a different type of loans to your advantage. A lot of people say, well, I don't want to have any debt. There is good debt out there. There is a way that you can have debt that's going to help you grow and help you grow smart. All these large companies have been around for 20 or 30 years. I promise you, they have business loans. The reason is they're using somebody else's money to grow, but they financially are in a position they can cash flow to take care of any of those. So I always say a whole lot of information in about 45 minutes. If you have any questions, there's a way to ask a question, or you can just put it in the chat.
And just a reminder, if you do not have a question now, this is going to be recorded. I'll send it out, and I will send Michael's contact information in case you have a very specific question for him.
I went ahead and turned off the Cash Angel. What? No questions at all?
You covered it. Everyone's ready to succeed.
Sometimes I feel like this presentation scares people more than anything else. But we always talk about it's so important to understand the mistakes and how a financial institution can help you and guide you so that we can help you avoid those mistakes for sure.
Yeah, I got the question wrong, so I was agreeing with everybody else. Obviously, there's a lot to learn.
It is. So Mike just chimed in there. It's scary. 100%. I don't disagree with that. That's why you need those people who are going to be in your corner. When you're ready to make that decision, you're ready to open that brewery, or even so that you're moving along in that brewery, it's that communication with the banker. And why I stressed local. We'd love to help people. We can help people throughout the United States. However, local connection is great. So you have that person to kind of lean on it and walk you through the process. I know when I cover it at the end and we talk about the loan workouts or the liquidation, it's why we talk about it, because it's a reality. It's a reality of when we're talking with somebody about whether we did or did not approve them for a loan. It's because we never want to be in that position. And it's not really for us. We don't want you to be in that position. We want you to be successful.
Looks like you also have a question. Does OnTap Credit Union operate in Hawaii?
I will fly out there to make sure we do. No, just kidding. Well, no, I'm not kidding. I will have to do a site visit. We can. So from the last presentation, I had people reach out to me, and we can do some lending. We can do lending in any of the United States, anywhere in the United States for business. The portion I would say for business and separating consumer is some of the support we have on the consumer side may or may not happen, and that's where I help some brewery owners. They get a home equity line of credit to give them that cash to open up. We can't in all states. However, business lending we can. As much as a joke it is, I really have to do a site visit. We almost helped finance a brewery in California, and I was like, I'm ready to go.
All right. So it looks like you have one from Anthony in the chat.
I see that if a bank is willing to give you a loan for a second location, but it's mostly based on projections, a bad thing. It's not a bad thing. So that's where we're going to take your history of that first location to be able to look at your second location. It doesn't guarantee success. However, if you're cash flowing in the first location, right, that's going to be the key, because we want to make sure that you're successful until you get up and running. So that's going to be a balance thing. Where projections are really tough for us is if it's your first location and you're projecting it. We don't have anything substantial. If you have a first location, example, we did Flightco Towers, their second location, and then with Guanella Pass, their second location in Empire. We have a history with them in borrowing, so we're able to use those projections of like, it makes sense what they're going to do in the next location. So we do support outside of Colorado. We do not do SBA. We do not do SBA lending. I do partner with different organizations. So if you're in contact with me, you want to go the SBA route, I have a couple different people I can refer SBA to. We talked a little bit in the last podcast on June 30th is something to think about for SBA. Breweries fall into the classification as restaurants, so they're high risk. So it's a little harder to borrow money with SBA. Exception, if you are sound financially on paper, you have a better opportunity at getting an SBA loan. Where that goes to is there more income coming in besides what the brewery's going to do? Okay. Glad we can offer some motivation there, Mike. You mentioned support frequently. Do you have reps in other states? I do not have reps in other states. I'm just here in Colorado. So for face-to-face, I don't. We've talked about partnering with other brewers guilds to try to grow that area. However, I do help outside of Colorado, and I have. So you're more face-to-face with me was going to be, which is awesome with teams, is you have that communication with me. I do suggest, though, if you can build a little local connection too, and that there's always that opportunity. Local is always best.
All right, we have a couple questions here. I'm going to ask a question prompt. Thinking about good debt, would it be better to get a loan than run through your savings to open a brewery? I have read about people that suggest people go through their savings that go into debt from the get-go. I'm talking about a nano brew pub starting at 3 to 7 barrel category. Thanks.
So I would say this. I would say hold your cash. If you have the ability to borrow money, and that's where smart lending comes in. We want to see that you have that 6 months of reserve. So if you have 6 months of reserve and that's your cash, and this question comes up all the time, is should I borrow money? But I don't need to borrow money because I'll just use my cash. Again, cash is king. You want to keep as much as you have on hand. Here's the plus to it. Let's say you're going to buy a brew house and it's $200,000 and you have $100,000 in your savings account. Well, if we only finance 80% of that, you have that down payment to where we can finance the other 80%. and it's going to put you in a better position, then you have 60,000 left over for the just in case. And as you know, if you budget, it's going to cost 500,000 to open your brewery. It's going to be 600,000. Like, it's always more expensive.
All right. And next one from Mark. What is your idea of what went wrong with Green Flash? I've read different opinions, but curious what happened. Seems to fit today's topic.
So I don't know the details on Green Flash, but I'm going to talk in general when it happens. Usually what happens, and we've seen this with Colorado breweries, is they grow too fast. So that decision of, because I make more beer, I'm going to sell more beer, I'm going to make more money. Or I'm going to open up a second location, and because I'm going to open up a second location, I'm going to make double the money now. Or I'm going to go into distribution because all the other breweries are going into distribution. Put a little asterisk on that. The nuance is COVID really forced a lot, no other choice but distribution, and your margins were little. But they make those decisions, and that's that back of the napkin decision is, did it really make sound financial advice? We were talking about I can't remember, it was Mike, someone asked about the second location, or Richard, is that, can we use your projections on your second location? We can, but we're going to make a smart decision on helping you on how much money maybe you should borrow. So that, to speak of a specific brewery, I don't want to speak to a specific one, but you are right. Typically what we covered is exactly what happened. The example of Joe's Brewery is they saw that top number, and our sales have doubled since we opened our doors. Well, when you get to the bottom, you're net money, but when you cash flow, you're really borrowing money to grow. So that's where smart lending comes into mind. So I hope I kind of answered your question. You are right. Most likely what happened to them was one of those three, if not all three.
All right. And Ken would like to know, if I am buying an existing operating brewery and the property using bank, SBA, and personal injection, do I have to be operating on day one after closing? I have heard I need the executed deed to be able to get a license. Seems like could be between a rock and a hard place.
Yes, rock and a hard place, not yes to the other. So it is, right? So we come across this when we're talking with breweries, is they need to get their TTB license, like they need to start brewing, but they can't buy the brewery equipment. Well, you have to buy the brewery equipment. You have to have a place to put the brewery equipment set up to get approved. So you don't have to be brewing from the moment you open your doors. That's that piece someone mentioned about using their savings. We want you to hold on as much cash as you can, because there may be a 1 to 6 month period before you even can brew beer to start making money because of all the different licensing. So it is a rock and a hard place. That's where having cash on hand is so important. And the SBA portion, I will say though, if you go the 7A route on the SBA, they typically, you're going to be approved for the loan, and you're going to have that draw period. So your brewery's not open, but you're able to draw for the construction, buying the equipment, hiring employees, before you even sell a beer over the bar top.
All right. Last question here so far. Speaking about those 3 key resources you should get involved with you, accountant, lawyer, banker, what would be the best stage to get them involved in your brewery? The planning, the deployment, the running?
Yes, to all 3. Here's why. In the beginning, you really want to talk with somebody, an attorney, in the beginning, because setting up your name, making sure that they can do the research for you, that nobody else has that brewery name. We see it all the time with the cease and desist. That is so, people get hit with that all the time, whether it's a beer name or a brewery name. So getting associated with your accountant, that's that interview process. We say, just like a banker, before you need to borrow money, make sure you're interviewing and talking with them. And nobody should, hopefully they don't have an issue with that. Again, majority of my time is spent talking to people who are in their planning stages. So start those relationships sooner than later. And the attorney, for sure in the beginning, because if you have an idea and you're going to register your name, the sooner you can register that name and protect your trade name, the better it's going to be, that you're not going to have to change names. You'll talk to many brewery owners, and I know a few here in Colorado who have gone through 3 names because they kept getting a cease and desist. When you ask a brewery, hey, how'd you come up with your name? You'll get, oh, this is our 3rd name that we came up with because of cease and desist. So sooner than later, start talking with them. And that's your interview process, actually. So same with an accountant. You can start talking to those breweries of who do they use? Can that accountant put on another person? And then what is it going to cost you to have that accountant? The banker is, hey, let's look at your finances. What are you going to do to borrow money? And for me is that what we're talking about, that SBA loan or borrowing money before you open her, are you going to have other resources of income when the brewery opens? If you're going to go to run the brewery, do you have other W-2 income or 1099 or other businesses or other partners income that you can use? So that's how we guide you through that process before you're even ready to borrow money. Is you need to do this, this, and this. So you really want to start sooner than later. Don't be scared. For me, I would say, don't be scared to have a conversation sooner than later. It'll really kind of give you that piece of that. Check the ego on our side. Is someone willing to talk to you? I mean, that's so important. If they're not, are they really going to talk to you when you need them in a crisis?
Great, thanks. And just a reminder, we actually had our presentation last month was a beer attorney, specifically beer attorney. So if you look on our Crowdcast channel or even our YouTube channel, or if you just want to contact 5-Star, we can totally direct you towards that presentation, then also get you in contact with that beer attorney if you have any specific questions. He'll definitely help you out. So
absolutely, and great advice, because these forums that you use and all these different podcasts and presentations, listen to them, because that's where you're going to get that information. And 100% right. If someone's given a presentation on here, then there's some great credibility with them, because not just everybody gets invited to do these presentations. I see Michael B put on their SBA 7 loan caution. They may place a lien on your residence. 100%. If you go back to our podcast from June 30th, we talked about that. And the downside or the cons of an SBA loan is they can put a lien on a lot of your property. The pro side is it may be the way that you get the money to open your brewery. So just understand what you're pledging when you do that loan. And I brought up in that presentation is we had breweries who wanted to refinance because the market interest rates were down and they couldn't because of the lien on it. Had a brewery owner that wanted to sell their brewery and move out of state. They couldn't sell their home to move out of state because they had to satisfy the SBA loan by selling the building. And so there's a lot of nuances to it, but it's a plus and a minus. And so, too, we have placed liens on homes for lines of credits. Same thing. So using your home could actually be a really good asset.
All right. If there aren't any other questions, just a reminder, we have John Palmer speaking next month, September 22nd, and then we will have Michael back in October to give a presentation. And this is being recorded. I will send it out on Monday and send out Michael's contact information. So thank you again for presenting, Michael. Some really valuable information. And thank you, everyone, for attending.
Thank you.
Thanks.